All right, so this week should be a little bit more macro focused than the last couple of weeks, which were centered around earnings. Of course, Nvidia going crazy today, maybe argues otherwise, but note that other than that last rip into the close, we keep having breadth issues, and it doesn't look like Nvidia is quite able to carry the whole market with it. We just eked out a couple basis points. Where there is a little bit more discernible action and news flow this week is going to be on the macro side for the economy with inflation on Friday, and bonds are already moving. The bears are getting pretty active again in Treasuries, which is why last week I took the green light off my risk radar for bonds, the way the 10-year had recovered the yield losses post CPI earlier in the month, and now the breakout through 4.5 with conviction. Now, I haven't changed the light for the dollar yet because there's something kind of curious happening right now. I can't quite wrap my head around it, but I think it's one of the most interesting charts. It's the relationship between rates and the dollar, and there's a pretty big gap that's emerged. 10-year jamming today. Dollar did eventually catch a little bit of a bid there when the confidence number was warm, but there still is a pretty sizable difference between these two. This might suggest that the central bank narrative globally turned a little bit too dovish perhaps, and maybe if we do get a cut from European central banks or the Bank of England that they might have to stop after that. So maybe that's applying a little pressure to the dollar here in the last week because we did see some better than expected data come out of the rest of the world. But generally, the two move in sync pretty well. And if the yield is breaking out, you probably are going to expect the dollar to move as well. Now, if bonds are wrong here, then that means we would have a big catch down in yield to where the dollar is, but I'm just believing bonds more than the dollar right now is the point. There's just a good bit of evidence here. We did get a couple soft weeks of economic data, but it's firmed back up again. The economic surprise rate is trying to go back to neutral, so it looks like we kind of have a couple scares there in the last month, but generally the pace for inflation-linked data is still pretty strong and pretty warm. So that's important as the 10-year is moving again. The other thing is that commodities are warming up too. The DBC commodity index jumping here, and that's even without crude oil. Watch WTI to see if it picks up, because WTI had a decent little move today, and if crude starts rallying on top of what we already got for the metals move, then the commodity index seems pretty well supported. And if commodities break back out, this is the year to date for the commodity index. I mean, we're right here basically at the previous high. So it kind of looks like it wants to break out. And if crude oil rallies, that'll definitely up the odds of that happening. Now, finally, watch the curve too this week. This is going to be important. The 10s to the 2s. We've basically been, the blue line has been mostly range bound since October. The white line S&Ps have been rallying through that. The sideways yield curve to me has represented the Goldilocks phenomenon. We're kind of stuck. But note, we're at the low end of this range right now. The 10s to the 2s are getting pinched here in the last week as long end rates have moved, but the short end has moved too. So you're getting the yield curve pinched a little bit. We don't quite have the right combo of growth and inflation. It looks like the market's starting to worry a little bit that that combo is moving south. So if we break down in the yield curve while rates are moving up, stocks probably won't like that. I'll see you tomorrow.